Hi and welcome back to the channel. In this video, we're going to be analysing C Limited. Ticker symbol is SE and it's traded on the New York Stock Exchange by way of Singapore. It's a stock that has caught the attention of many, mainly due to the 450% increase in less than a year that it had in 2020, but also because of its exciting business model. It's been requested many times on the channel, but more specifically, it was chosen by our patrons on the most recent poll to be one of our next stock analysis and valuation candidates here on the YouTube channel. So in this video, we are going to review the business and its operations to try and get a better understanding of its business model and business economics. Second, analyse C's fundamentals and why it's become a powerhouse in Southeast Asia. Third, look at the potential for growth based off of what we know about the company and its addressable market. And then lastly, we're going to create a forecast and evaluation model for C stock to see if it's currently a fair price to buy today, and if not, put a target price on it to capitalize on any dips that may occur. C are a consumer-facing internet and technology company based in Southeast Asia, or Singapore more specifically is where they're headquartered. They operate under three integrated technology platforms, which include digital entertainment and gaming, which is Garena, e-commerce, which is Shopee, and digital financial services and payments, which is C Money. The first of these three businesses to exist is the digital entertainment business called Garena. Garena has been around since 2009 and is a global game developer and publisher. They exclusively license and distribute games for third parties, but also develop their own games in-house. They provide access to these online games to mobile and computer users around the world. The most recent development was Free Fire that they developed in-house, and which turned out to be the most downloaded mobile game in the world in 2019 and is the highest grossing mobile game in places like South America and Southeast Asia today. The business is growing at a rapid rate, with active users growing at 72% year over year and paying or monetized users growing even faster at 120% year on year. So as you can probably guess from this, their revenue in this segment comes from users purchasing premium and in-game items and things like season passes, because the majority of their games are actually free. And the percentage of total users that are monetized on this platform has grown from 8.4% to 10% in just 1 year, which marginally is actually a big improvement, around 20% to be exact, just in 1 year. And they've shown a big commitment to keep growing this segment with the acquisition of US games developer Phoenix Labs back in early 2020. The second segment of the business we need to cover is the e-commerce platform, which is called Shopee. Now, you can think of Shopee like an Alibaba or JD.com's marketplace platform where they connect buyers and sellers, but also do purchase products directly themselves to store and sell direct to consumers on their platform. They have a mobile-first approach, which is aimed at driving the whole transaction process through their mobile app rather than having to use offline or web versions. They believe this approach will prove more sticky to future and existing customers as mobile penetration grows rapidly in Southeast Asia and other regions that they serve. As you can see from this table, though it's blurry, they are dominating mobile e-commerce in every Southeast Asia country that they serve as of 2020. They don't quite win on the web visits, but I can very much understand their mobile penetration thesis. And Shopee earns its revenues from advertising for sellers on the platform and commissions from transactions for buyers and sellers, which both of these monetization methods are a byproduct of the GMV, which is essentially the volume of orders on the platform in dollar terms. And you can see here that it's growing rapidly with 113% year over year growth. Also factor in that when you look at revenue, Shopee is becoming more effective at capturing GMV as net revenues. So again, another sign that they are monetizing more effectively. And the e-commerce platform is actually growing to around 50% of C's total annual revenue, which will make it the largest part of the business in 2021. And last but not least is the digital finance segment that integrates these three platforms together, and it's called C Money. So C Money offers e-wallet payment services, payment processing, micro lending, and credit to consumers in Southeast Asia. They offer standalone services as well, but Mainly, their products are integrated into the other two platforms. And as with all finance and payments products, C-Money earns its revenues from transaction fees and interest on credit. So the main KPI is the total volume of payment transactions, which reached $7.8 billion in 2020. Now, this isn't a large segment of the business yet, but it only really just got started with it being branded as C-Money in 2019. Current revenues are nothing to get excited about, but they have had acceptance for a digital banking license in Singapore, which could be used to great effect, and especially given that only them and one other business currently hold this license. So now, before we start to talk about the future growth for C Limited, let's just look at the current financials. I just want to emphasize how well this company's done over the past 3 years. You can see this here actually averages out to around 120% average compound growth rate over 3 years, which is quite remarkable. They have lost a lot of money though. You know, this operating income margin has been sliding down. Well, I mean, come back up in 2020, but still losing 30% of their revenue. So for every dollar that they're making, they're giving away $1.30, which isn't ideal, but at least it's improving from the year prior. Somehow off of that, they're free cash flow positive with a free cash flow margin of 12.5% in 2020. I've got to say, when I see something like this where they're losing that much money and then free cash flow is positive, I usually just ignore it rather than take it as a good sign. The difficult part about this valuation is going to be estimating margins, in my opinion, because the digital entertainment part of the business has really good margin profile and gross margins are very good. It's profitable, but it's quite obvious that the largest part of this business will become the e-commerce part because that is the largest total addressable market. It's also growing the quickest and it's already the largest by around 4%. Unfortunately, that part of the business doesn't have a very attractive margin profile, so it isn't leaving much room for an impressive bottom line in that e-commerce unit, I have to say. We can see here shares outstanding have grown quite significantly, but it looks like all of that has just flooded to the balance sheet. So we've almost tripled shares outstanding in 3-4 years, which not ideal to see, but the majority of these shares that have been raised looks like they've been taken to the balance sheet. They now have 6.2 billion of cash on hand, which is good to see because they're going to lose some money going into the future, and how much cash they will burn will then depend on how much shares they'll have to raise, and that will result in shareholders being diluted. So good to see they have some cash still on the balance sheet. Debt's at 2 billion, which is higher than I would have liked, but with this valuation, it's not going to be too much of a problem. I mean, they could raise an extra 1.5% shares outstanding and write off all of that debt. So not to be too concerned about that. What I will point out though is you can just see here what a ride this company has had. Back in 2019, trading below $43 per share, now at $255. And if we look at that, in terms of the whole company, that's gone from $18 billion valuation to $126 billion. And you can see here that I've made some assumptions, right, based on the fact that imagine they had a 15% operating margin at the moment, which would be fantastic. What does that price to EBIT look like right now? Because we don't have a price to EBIT. That price to EBIT, even with a 15% margin, is 192 times. So, a very, very big valuation, but for a very fast-growing company. Price to sales, or EV to sales, they're currently at 28 times, which again is a very high valuation, but it is a company growing 100% top line. So it's a sort of thing that we've come to expect in this market. Now what I'd like to do is look at the potential for growth that C has based off of its addressable market. We've looked at their products, we've looked at the services that they provide, and it's clear that they attract customers. It's clear that they offer very competitive solutions, especially in an underdeveloped and underpenetrated internet economy in Southeast Asia. So now I'd like to put a scope on their market and see what sort of growth they can pull out of it over the next sort of 5 to 10 years. So there was this interesting report that was done by Google and Bain Research, which they do every single year, and it basically in-depth research on the Southeast Asia internet economy and how it's going to develop over the next 5 years. And I'd recommend taking a look at the full report if you are interested in investing in C, because it does give some really in-depth information on how this market is going to develop. But firstly, I just want to point out this. So this is a big market in terms of the actual population. Now, we know that their business, C's business, driven by the amount of users that they can attract onto their mobile applications. And the reason why is because, like with all of these similar businesses, they benefit from what's called the network effect. For instance, if we take the e-commerce business, sellers are going to sell on Shopee if there are more buyers attracted to Shopee, or if there are more buyers on Shopee, or more buying activity, sorry. So the point I'm trying to make here is they've got a population of 583 million at a minimum. This is just in Southeast Asia, their biggest market, that they can target over the next 5 years, and that's almost double the size of the US population. But as you can see here demonstrated, the amount of internet users in Southeast Asia is growing rapidly, with only 260 million in 2015 up to 400 million as of 2020. Google estimate the internet economy in Southeast Asia to be around $100 billion GMV. Now they expect that to move up to 300 billion as of 2025, so almost a triple in the next 5 years. If we break this down into countries, it looks like Indonesia is going to be the main driver in this, going up to 124 billion within its own country. And that's a 23% growth rate. You've also got Thailand, which is going up to 53 billion, a big contributor, and Vietnam as well. Every single country, though, none of them lagging in growth, even Singapore at 19% year over year. And when we break this down into sector, what we want to focus on here is e-commerce mainly, which is the biggest market by quite some way. $172 billion they expect this market size to be in 2025. And that's a compound annual growth rate of 23%. So not as quick as the growth rate that we saw in 2019 to 2020, which is 63%, but still a very big number for a 5-year period. Online media as well, which is their digital entertainment business, that will come under this. That's a 15% compound annual growth rate as we get into 2025. And they expect the total market to be $35 billion US. Digital financials are a little bit more complicated because we're looking at digital payment gross transaction values here. They would only be taking a transaction fee based off of this, but we can see that's expected to grow at 15% compound annual rate over the period as well. So every single market, every single sector seems like it has very high growth potential for C. And honestly, I'll say it again, I'd recommend reading this report if you are interested in C, because it gives you a lot of the information that you would want to know. The unfortunate thing is that it's 128 pages long, but I'll leave a link in the description if you're interested. Okay, so let's get on to the important bit. This is a valuation, and where we're going to try and put a price target on C stock and see if it is undervalued or not. Top line revenue growth I've got growing exponentially, as you probably would expect. They're growing at around 100% at the moment, and they actually gave guidance for 2021 that they should reach around 8.8 billion on the bottom end of their guidance. So that's what I've gone for 2021. And then after that, I've had to drop it down because growing at 100% year on year just isn't sustainable. If they did that for long enough, say 5 to 10 years, they'd be bigger than the economy that they serve. So that's not going to happen. I've dropped it down to 50% and then down to 45%, which is the range at which some of the larger e-commerce companies are growing at the moment. So I thought that was a fair growth rate. And you have got to factor in, this is a 10x in revenue in just 5 years. Now, I know they 10x'd in 4 years previously, but they're going to have to 10x off a larger number now. And just as a smell check, I've got here C's total addressable market, or what I think their total addressable market is in 2025, and that's around 200 billion. This would mean they have market share of around 20% as of that period, which is a very big number, especially considering how broad that market range is. Now, I will admit, on the margin and free cash flow side of things, I've had to settle for somewhat of a ballpark, and I've gone with 10% because this is never going to be a high margin business, especially if the e-commerce side of the business continues to be the largest segment, which, let's be honest, it definitely is. And I think if we look at some of those first-party e-commerce platforms, take JD.com, take Amazon as an example, even Mercado Libre, their target margins are around 10 to 15%, and some of them are at that at the moment. So I think 10% is conservative enough, but also would be a good enough margin to warrant forecasting it. Shares outstanding are growing at 1.5%, just in case they need to raise some cash, because they are going to be making a loss, which I'm not accounting for here. And the ways in which I think would be fair to value this company is an EV to sales and an EV to EBIT multiple. Now, bear in mind here, I'm trying to be conservative if I can, because these valuations here aren't meant to give us the exact numbers into the future, because we just don't know what the numbers are going to be into the future. But what they should give is an idea of what's reasonable. Okay, so what's the reasonable numbers that we can forecast into the future? What are the reasonable multiples that this business will have on it in the future? We're never going to know exactly, but it's more of a smell check than anything. So I think 5 times sales is a fair enough multiple for this company in 2025, given that that's over what Amazon is selling for at the moment, or were selling for when they were in really high growth mode, just because the margins aren't huge, and especially with gross margins being below 30%, you're never going to get a 10 times sales estimate. That's for those really high margin businesses like a software company. They usually get 10 to 20%, 10 to 15 times EV to sales. Not the case with this one, unfortunately. With the EV to EBIT multiple, I've gone with 35 times, which again is a fairly high multiple, but for a company growing at 45%, still seems conservative. Now, we average out those two terminal values and we get 181 billion for the company in 2025. That equals a share price of $340 in 2025. And unfortunately, that does mean that the stock is somewhat overvalued today, just based off of these forecasts up here. And based off of my estimates, a good price to buy the stock, if you want a 15% return, would be $156 per share, or 83 billion for the entire company. Whether we will get a dip back down to those levels, I really don't know. The stock has gone up by quite a lot. We have seen a dip recently, but it surged back up. So whether we will see that sort of level on this stock again, I really don't know. And this doesn't mean, if you were looking at it from a 5-year perspective, to sell the stock because it's overvalued based off of these estimates. I wouldn't advise doing that. It's more just demonstrating what sort of price I'd be happy to pay for it if I'm opening a new position. What I will show you though, if we stretch this out to a 10-year forecast, right? Let that growth play out just a little bit longer. It does reach some really big numbers. We do get to 116 billion in revenue by 2030, which you could look at and go, how on earth would you know that this company could reach over 100 billion in revenues in 2030? And the honest answer is, I don't. But it definitely could. And that would be a 10-year growth rate of around 41%, which is very impressive. Margins kept the same at 10% because I haven't seen any signs that they could beat that. Shares outstanding growing at the same rate again. And although this doesn't get us to fair value today, it gets us closer and means that off of this 10-year estimate, a fair price to buy the stock today would be $223 per share. We're currently at 255, so around 10 to 12% off of that, which is, not too bad. As you guys know though, if I can, I like to operate on a 5-year basis just because we have a little bit more clarity and more confidence around those estimates, stretching out 5 years rather than 10. When we get up to 10 years, a lot of stuff could happen in that decade and it just gets a lot more blurry towards the end of the period. Now, what I will say about C, and I say this about a lot of the stocks as well, is that this has the potential to outperform these estimates, no doubt about that, although they are punchy. I personally wouldn't be buying at these levels just because the numbers don't make sense based off of reasonable or even slightly bullish estimates, or by my accounts, I think these are bullish. And that's not to say the company won't do well over the next 5 years. I think it will do very well. And when you think that their market cap is currently the same size as JD.com's, and that JD.com has over 100 billion in revenues and probably quite a similar margin potential. So I'd just like to look at that as a comparison and think, I'd probably put my money in JD.com if they were selling for the same price. Chinese market's a lot bigger as well. And although C looks like a great business, the stock is priced a little bit too richly for my liking at the moment. And that's all for this video, guys. As always, this spreadsheet will be available to the patrons on the Patreon page and on the Discord. So go ahead and check that out if you would like to support the channel and also get access to all these valuation models and some other benefits as well. Leave a like if you enjoyed the video. Let me know in the comments below what you think of C. And of course, subscribe to the channel if you haven't already. I will see you in the next video. Good luck with all of your investments.